Welcome to the Iron Sharpens Iron VAT Conversation Series. Actually, this series is all about VAT. So this is series 1, which is introduction, just to get the ball rolling. Now, to introduce you to this section, we are going to introduce you to VAT and explain the terminology involved. That's the main thing in series 1, just to ease you into the discussion because it can be overbearing. It is important to know that VAT is a consumer tax. It's not a tax that is supposed to be paid by your business. It is a tax levied on the consumer for which the law requires qualifying companies to register and collect VAT from your customers on behalf of SARS. Now, VAT is an indirect taxation system. It was introduced on the 21st of September 1991 at the rate of 10%. The predecessor, for those of us who are older, there was a general sales tax, GST. The rate was increased to 15% on 1st April 2018. Thank you, Parliament, and those parties that did not vote for an increase. Otherwise, the consumers were going to be in trouble because Treasury had decided to increase this to 15.5. It was we just dodged the bullet by a whisker. This form of indirect taxation is levied on goods that it could be capital goods or it could be stock that you sell to your customers. There's a Department of Excise and Customs that is responsible for collecting VAT on imports, all imports. That is a part of the DTI. Now, VAT importers are also required to fill in forms and pay VAT over to SARS, irrespective of their vendor status. I'm vendor, so I don't know why they're discriminating and talking about vendors. Why not Sutus? Why not Zulus? Okay, responsibility for VAT in company. It is your responsibility as the owner of the business. You might be a shareholder, you might be a director involved in the day-to-day management of the company. The onus falls upon you. Don't outsource this responsibility to a tax practitioner or whoever, because I've come across many business owners who have been left high and dry by bookkeepers. They just felt that this is too much for me. It's a nuisance to me. I'm going to leave it to a bookkeeper, and they'll they become the Superman, the Spider-Man for me. They'll sort it out. And when the tax practitioner disappears, these people are left high and dry. So if you are playing around with VAT, with tax, you are playing around with fire. Let's look at the terminology, because terminology is very important here. Key terminology: value-added tax. This is a tax that is levied on the final consumer of products and services, the one who buys the soft drink, not to sell it, but the one who buys the soft drink to drink it. That's the consumer. So as a business, if you're selling bread, you are a bakery, you are selling soft drinks, this is not a tax on your business, but on the final consumer. VAT registered businesses have the responsibility to charge VAT on products and services and pay over to SARS the money that they've collected. Now, here is another term: VAT input concept. This concept refers to the money charged to you by other businesses on the goods and services that they supplied to you. Remember, as a business, you do buy from other businesses. So that supplier who sells to you charges you VAT. They collect it on behalf of SARS, from you on behalf of SARS, and you will recover it from SARS. So there's a chain there. You are entitled to claim this money back from SARS, of course. Now, VAT output, what is it? VAT output is the money that you collect for goods and services that you supplied to your customer. You collect that on behalf of SARS, and you must pay it over. Don't use it. You have seen many celebrities in trouble for using this money. Now let's look at standard rated products. So what is this category? These are basically products and services on which VAT is levied at the rate of 15% as of now, because this rate is adjusted from time to time. There's a category called zero rated products. This might sound futile and senseless. This is a category of products and services on which VAT is levied, but what? At a zero rate. It is levied as a zero rate. It doesn't make any change, but there's a method to this madness. We'll explain as we proceed. Exempt products. Exempt products are product categories on which VAT is not levied at all. So this is not zero rated, it's exempt. If you are dealing exclusively with products and services that are exempt, you don't have to bother registering for VAT. And VAT fraction. This fraction refers to formula used to calculate VAT amount from a VAT inclusive amount. Now, this is very interesting because whenever I go to training, maybe 95%, 98% of the time, the learners get it wrong. Suppose you see an advert of a new air fryer with a VAT inclusive price of 1,000 rands. How much is the VAT? How do you calculate this one? We'll have a look at that. What you then do is to take the 1,000, you multiply by 15 over 15, because VAT fraction is 15 over 115. Why 15 over 115? 15 is the rate of VAT. What is 115? Remember, it's 100% plus 15. Why 100%? Your price already, it's 100%. Whatever price, it's a complete price, it's 100%. And the VAT is added on top of your price. So 100 plus 15, it's your price plus 15% to be added. You multiply by the price that you are charging, 1,000. It will give you 130. 130. There's a slide that I missed there, but here you calculate 1,000 by 15 over 115. It will give you 130, which is the VAT included in the 1,000. Now, how do you charge VAT on your prices? If a price was 1,000 rands inclusive of VAT, 15% included, then it means that 130, we calculated it, remember, if you subtract 130 from 1,000, it means your price was 870. Let's look at how to calculate VAT output. Now, to calculate VAT output for standard rated supplies, I've already done that. Price by 15 over 115, it gives you that amount. Zero rated supplies, it's the price multiplied by zero. It will remain. It will not make any difference because it's just at zero. You still add, this company that are dealing in zero rated products, they still have to add VAT, but the VAT is added on at a rate of zero. It sounds crazy, but we'll explain as we go forward. Adjustments, there are adjustments, and I'll explain what adjustments are. Here is the calculation that I'm talking about. 1,000 by 15 over 115 equals to 130. Zero rated supplies, 1,000 by that comes back to zero. Adjustments, what are adjustments? This you'll get in the VAT form. It's when, for example, you have written off an irrecoverable debt, or when you have issued or received a credit or debit note, or when you have received or given a discount for early settlement. You have to adjust this amount. Goods received are returned, and that's also it happens when goods received are returned by a customer you have sold to a customer and they return a product. Now, the conversion. Okay, this line on the adjustments on your VAT returns refer to one. You might have to make adjustments on your VAT return based on one or more of the following scenarios: where you have written off a debt of a customer, the customer is no longer able to pay you because maybe you cannot trace them or they no longer have an income; when you have issued or received a credit or debit note. For example, if you have been overcharged by a supplier, they might issue you a credit note. If you yourself have overcharged your customer, you might have to issue a credit note. Yes, when you've overcharged your customer, you issue a credit note. When you have charged them too little, you will have to issue a debit note to correct that. Another scenario, that's when you have received a discount for early payment. Remember, you received an invoice of say 1,000 and to be paid over say a month, and the condition is that if you pay it within 2 weeks, you will receive a discount. Then you will have to adjust your VAT forms accordingly for that, because what will happen is that your VAT to be paid over to SARS would have appeared to be more than it actually was, because, for example, 1,000, the invoice, tax invoice from your supplier say was 1,000. You pay it early in 2 weeks, and then they gave you a discount. You are paying a total of 935. Your VAT obligation is going to change. That will need to be adjusted to show that, oh no, I thought I was going to pay, I thought I was charged so much. Actually, I've been charged too little. So you are not going to claim all the what is it, all the 130 from SARS. You'll have to SARS to claim VAT for input tax for a price of 930. That's the adjustment. Now, say for example, you have returned some of the goods to your supplier. That will have an implication, because the volume and the value is no longer the same. The value of the goods that you bought is no longer the same. Adjustments have to be made. A change in the extent of use of taxable goods has occurred. Remember, businesses are not charged VAT on their purchases because the purpose for buying goods is to help the cost of running their businesses. You are not charged. You are not liable to pay tax VAT, but you are still charged because there's a procedure of how you get refunded from SARS. Your supplier will charge you VAT, but because you are a business, you are not the end user, you will still have to, you will pay your supplier, but you'll go and claim the VAT that you paid the supplier from SARS. That's what happens. Now, goods received are returned by a customer to the supplier, or your customer has returned goods to you. That necessitates an adjustment because the value changes. That's why we have that adjustment on the VAT column. Now, there's a change, say there's a change in the extent of use of taxable goods. That is okay. That's what I'm busy with. And the best way to explain this thing, I have said businesses buy products and services from other businesses for the purpose of running a business, not for the purpose of consuming those products. That's why you have this line, changing the extent of use on your VAT form. But this one, now I'm going to simplify it for you by using an example. Suppose you run a bakery business that is registered for VAT. You buy a buggy for your business. Say it's January 2016 for 50,000, and remember in January 2016 VAT rate was still 14%. This means that you would have claimed from SARS 6,140. That is VAT amount included in 50,000. Take your calculator and say 50,000 by 14 divide by 114. You'll see that gives you 6,140. And whatever question, ask me on the comment section. Many people have got hard time doing that because they want to use 14 over 100. No, the VAT fraction is 14 over 114. And it is because the 14 is the VAT rate. That's the formula. VAT rate over price plus VAT rate. Your price plus VAT rate. Your price is 100%. VAT rate is 14% on top of your price. That's how it comes about. You derive all income. Remember, you use your buggy to run your bakery. That's the purpose. That's why you claim that 6,140. SARS give it to you back. In April 2019, you decide to renew the buggy and take it home for use by your son. Now, something drastic has happened. The buggy is no longer working for the business. It's now being used by your son to do that, maybe to go to school. Use it to go to school and take their siblings to school. Say, for example, it's 2024 and the value now of the buggy is 30,000. What is supposed to happen? You are supposed to say 30,000 by 15, because in 2024 the rate has been adjusted upwards to 15%. You say 30,000 multiplied by 15 over 115, it will give you an amount of 3,930. This means that you have to pay SARS, over to SARS, an amount of 3,913. You owe them because already you've claimed 6,140 under knowing that you are going to use it for business, but now the purpose has changed. It's only fair that I don't know how SARS police such a scenario, but that's how it's meant to work. Now, how do you calculate VAT input? Simple. For standard rated supplies, remember it's 14%. I've showed you an example, and this includes all imports for standard rated supplies and capital goods. Now, you take inputs tax on other goods and services for your rent, for your stationery, and for travel, for advertising. Remember, VAT, we do it assuming you keep your books. The best way, when we now do the calculations in your VAT form, there's no other way. Your record keeping system has to come into use. And then you take the change, adjust the change in use, that is for your input. The change in use, that's when you are claiming, for example, you had, in this situation, you had a buggy which was working from home. Now you have brought it into the business to work for the business. You'll have to claim that 3,000 and something. It worked both ways under output and input tax. You take your bad debts, you add it there. That is part of your VAT input, the procedure. That is the procedure there. Here I was just showing you how to calculate. Is that calculation of how to calculate VAT on a price of 1,000 using the standard rate methodology. VAT refundable. How do you do it to know whether SARS owes you or you owe them? You take all the input tax that you have calculated, the output tax, what you have collected on behalf of SARS, you minus what SARS owe you. You add penalty and interest if you are late, and then you get your VAT refundable. Done and dusted. Questions, send those questions. That's your introduction.